Hello and welcome back to Green Money Momentum, where we talk about market movements, making money, and money momentum. Today we're going to be talking about options contracts, and more specifically, long bullish calls for the future. And it is in my opinion that option contracts are one of the greatest financial instruments ever created. And so today I'm going to be talking about one specific option strategy that is super easy to follow and about anybody can do. So myself, I run a business during the day and I just don't have the most time to look at the financial markets. And so for this strategy right here, it works perfectly for me, as I can make a decision, I could buy my options contract, and I could put away my investing app and live my life knowing that I've made the right decision. For this strategy right here, I recommend it to anybody who is long on the market. And this strategy can be looked at a lot like just buying shares and holding those shares in a company, but the multiplications are so much better. But first off, as always, I want to say that this is not financial advice, and I always recommend doing your own due diligence before making any financial decisions. So let's hop into it. So when it comes to options, there are a ton of different strategies. You have long calls, covered calls, long puts, cash secured puts, vertical spreads, straddles and strangles, and so much more. But we're just going to be talking about the most simple of them all and a strategy most could follow. And so just to give you a background of where options trading started for me, I originally heard about options trading through Wall Street bets, where people would post the most insane losses ever. And really the impression I had on options trading was that it was basically just gambling and a way to eviscerate your money. But that is not totally true, and once I did my own due diligence and I really understood the bigger picture, I could see how wrong everybody on Wall Street bets was really doing it and how amazing options really are. And so with options, you're given the ability to buy 100 shares of a company for a premium price. And so with these contracts, you pay a premium. So in this example, we see that 100 shares of stock is going to be at a premium of $3.60. And now let's remember to multiply that by 100, because there's 100 shares of stock within that options contract. So the premium is $3.60 per share, but when you multiply that by 100, it comes out to $360. And so I'm going to show this real life example of an options contract that I have recently done. I bought this options contract on November 18th, and this is for SoundHound AI. So when I originally bought this contract on November 18th, the underlying stock value was at $6.19. So had I just bought shares instead of options contracts, my current multiplication, my current profit would be at 386%. But here's where options contracts, in my opinion, are the greatest financial instrument and one of the most liberating ways to play with your finances. This is just in about a month's time. I am up 1,333%. So options are a derivative that could basically be looked at as like the betting market for stocks. And so for this contract specifically, the average cost when I bought it was $1.16. So for 100 shares, it was only $116, opposed to had I bought 100 shares of SoundHound at that $6.19, being a total price of $619. So essentially, I was able to profit from the same movements, but with $500 less when it comes to buying an options contract versus if I had bought those 100 shares. And the reason that option contracts move so much more than the underlying stock is because that their price is not only based on the stock price itself, but also includes a significant time value component, which can fluctuate significantly depending on factors like volatility and time until expiration, leading to larger price swings even when the stock moves relatively modestly. So that all seems fantastic, and of course that seems like a no-brainer decision when you put them side by side. But this is where Wall Street's bets had me very confused back in the day, and a big reason why I stayed away from options contracts for a long time. And if you don't know what you're doing, you definitely eviscerate your money without really knowing why. Going back to the SoundHound AI options contract, we could see that my expiration date is on 4/17. And so when it is April 17th, I'm going to have two options. I could either exercise that contract and buy those 100 shares at the underlying price, which in this case is a $7 call. So come April 17th, if it expires, I could exercise this contract and buy 100 shares at that underlying price of $7. Or anytime leading to that, I could sell the options contract for a profit. And another factor for investors to think about when playing with options is, even though my options strike price was at $7, the break-even price was at $8.16. So if it comes to April 17th and the stock was not at $8.16, the options contract would expire worthless. And so when playing with options contracts, here's one of the best ways to know whether you really have a chance to profit or whether you're just donating your money to the market. You have at the money, which means that the option strike price and the underlying assets price are equal. In the money, which means that a profit exists because the option strike price is more favorable than the underlying asset price. And out of the money, which means that no profit exists when comparing the option strike price to the price of the underlying asset. And so, for example, when we look at my $7 options contract for Soundtown, currently I am in the money huge as the stock is currently sitting at $23 and I have the right to buy these 100 shares at only $7. And so what I was saying earlier, and where I was originally a skeptic because of Wall Street bets, what a lot of investors will do is they don't really put that options contract to expire far out into the future, but they will put it on a date that is coming up in the very near future. So here's an example. When we look at this Soundhound contract that is to expire in just 4 market days on January 3rd, the break-even price is at $39, but the cost of the premium is only at 31 cents. Again, times that by 100 and you're going to get a total cost of $31. Likelihood of Soundhound going all the way to about $40 in just 4 days is highly unlikely. Look at that same options contract expiring next July. The premium sits a lot higher at $6.80 per share, which would equal $680 to purchase all 100. But the reason for this is because it is a lot less risky to buy that same contract but have it expire in the 7th month of next year instead of just 4 days from now. And this is just one out of the money options call I have chosen because the premium is a lot lower than if we were to put more near in the money. So if you were to go down and look at calls that are closer to being in the money, the premiums are also going to be a lot more expensive. But the reason for that is because the risk is a lot less, as you are more likely to be able to cover that option call and be in the money sooner than later. And so what I've been doing with the options market is I've been playing a lot of the AI stocks. There's a lot of volatility, but I don't want to put a lot of capital into each place. So what I've been doing is I've been buying options contracts that are set to expire far out into the future for cheap premiums. And I've been profiting massive off of these movements with a lot of leverage, as it took very little capital to be involved with these plays, but the multiplications and the returns have been insane. So here's another real life example of how the options contracts move so much more significantly than the underlying shares. This is for another AI stock that I haven't actually done a video yet on, but the ticker symbol is GRRR. And so this Friday, my options contract gained 224%, while the original shares gained just 21% that day. And if you're still confused onto exactly why these options contracts are so much more valuable than the shares, think again how options are a derivative from the original stock market. So they are basically the betting market for the stock market. And there are a lot of other factors that are going to make your options contract move a lot more significantly than the underlying shares. So when you buy shares, you are doing just one action. You are buying those shares and you are holding and hoping that they become more valuable to eventually sell for a profit, but you don't have anything like time decay or anything like that to worry about. With the volatility when you hold shares, the biggest risk is just your money could lose a little bit and then you're going to have to hold on that negative position. Whereas with options contracts, you are going to have a set expiration date, and if the underlying stock hasn't met the break-even price, your options could expire worthless. But in my opinion, I consider holding shares just as much of a risk as holding options contracts, especially if you're playing them smart like I'm talking about, setting them to expire far out into the future. Because either way, I'm going to have to put up 100% of my capital. And of course, I'm talking about all of the positive scenarios, but it doesn't always turn out positive. We're going to look at a position here I opened for the Bitcoin iShares Mini ETF. And I opened these positions on the exact same day. So we could see that my shares are down 2%, whereas the same options contract I bought on the same day is now down 63%. But what I really love about options contracts is even though I am down pretty significantly on this play, 63%, if there is a turnaround in Bitcoin, I should really see my options contracts gain a lot more value than the underlying shares. And what's also exciting is if you are wrong on your options contract, you could always roll these positions into the future. So with options contracts, you could either roll your positions into the future. So you're just going to buy options contracts that are set to expire farther out into the future. So say you had one set to expire in January, but you didn't believe that the stock was going to hit the underlying price and the break-even price, so you're looking to expire worthless. You could always roll these contracts into a future date. So in this example, we're talking about January. You could roll these maybe into an April or a May contract. And now that is if you're out of the money, but if you're in the money at a profit, you could also do what a lot of traders do, which is they just sell their options contract before the expiration date at a huge profit. And then the last thing we talked about is you do have those 100 shares, which you could always exercise at any time, by expiration date or before that, if you are in the money. That is my video on options contracts. I appreciate everyone who came to watch today. Please drop a like, please leave a comment, and please subscribe to the channel. Thank you so much and have a great day.